need to take a look now at the efficient market hypothesis. In the early 1960s, Eugene Fama published his PhD dissertation, The Behaviour of Stock Prices. His aim was to try to explain the predictability of stock prices, but what he concluded was that stock prices are not predictable, and that was because the market is too efficient. In an efficient market, he argued, as information becomes available, many people, and he called them rational profit maximizers, and remember that term, many people aggressively use that information in a way that causes stock prices to adjust instantaneously before anybody can profit. In this efficient market, future predictions are futile as the market just adjusts to new information too quickly. And he conceded that there was no practical way of testing how efficient the market was because it was so efficient. He argued that it was obviously efficient because there was an absence of trading systems or investors who could consistently, over a long period of time, outperform the market, and therefore the market must be efficient. It might be argued that in the 21st century, with the prevalence of computer trading, the markets have actually become more efficient. But even Fama accepted that markets would not be 100% efficient all the time. He accepted that it did take time for stocks to react to new information and adjust to fair value. Random events are also acceptable, but it was argued that the effect of these would be ironed out as prices revert to the norm. So when we take these three theoretical concepts of the efficient market hypothesis, the capital asset pricing model, and modern portfolio theory, we combine them and arrive at a price-driven understanding of markets and company values. All these three are really focusing on market price, and that is the critical issue and the critical core common factor that all three have when it comes to actually measuring how they work. Today, investors and fund managers use price as the key yardstick of performance, underlaid by the modern portfolio theory thinking in these three elements of it. They focus on returns based on quarterly performance measured by price. They judge the value of stocks on the basis of earnings per share and price-earnings ratio, which come back to price. For this to make sense, you have to accept that modern portfolio is right, that the capital asset pricing model is right, and that the efficient market hypothesis is right. But how does your perspective change if that is not the case? And we need to look at this in our next lecture. So that's a quick summary of the efficient market hypothesis. You just need to take on board that this is saying that markets are efficient, that it's impossible to outperform the market because the market adjusts to the information that's available too quickly. But in the next lecture, we're going to challenge the whole of this premise, all three of these legs, and try to come up with the beginnings of a new approach to investment.